And, well, your initial thoughts when you saw the news?
I think, first of all, the overall Asia financial markets, I would say, is actually quite stable. A lot of the bank capital ratios are actually quite healthy in Asia. We don't have the kind of issues that some of the U.S. regional banks or even kind of Credit Suisse is having at this juncture in time. However, I think how the kind of European markets behave towards the AT1 will probably have a kind of shadow effect in terms of the Asian market. So we probably need to look through in terms of what's happening as the European and the U.S. market open later today as well to see the real impact.
Is there that big contagion risk, though, you think? What areas of the market that you cover is maybe more particularly vulnerable to that?
I think at this juncture, the sentiment is definitely a little bit weaker compared to the past few weeks or the past few months, given the China reopening. That's probably a healthy kind of minute for investors to kind of take stock in terms of what things are. It will probably mean that some of the kind of strong rebound that we've seen probably will get a little bit pressured. But overall, I think if we look at the fundamentals, in the longer run, I think Asia or even China is slightly in a kind of different business and economic cycle and even monetary cycle compared to U.S. For example, China last week just did a triple R cut and is released about $500 billion into the market. And at the same time, that kind of helps in quarter-end liquidity. It also put a stance out there with the new Li Qiang that they're going to be more pro-business, much more accommodative and supportive when it comes to monetary policy, particularly to the private sectors as well as the household sectors as well.
You mentioned about the triple R cut. Should I expect a policy cut then?
There is actually, we do think that there's a possibility for the LPR cut that's particularly related to the property sector in order to kind of stimulate loan growth or the mortgage towards the property sector. In a sense, it's a complete kind of policy because end of last year it was more about the supply side. It's more about stabilizing the overall property sectors, ensuring that property get completed. And then now it's more focusing in terms of inducing demand coming from household and kind of that's why the potential policy rate cut could reignite some interest in terms of property purchases as well. And we have also seen the first 2 months in terms of property sales data have stabilized. Some may see tier 1 cities kind of picking up as well. On the ground, we do see more active traffic when it comes to those sales center for properties. I think the other two indicators that we've picked up that we think is quite interesting is that one, some of the high tier bank cities, the land bank prices have kind of come to the higher end of the expectations. That's definitely a good sign that developers are gradually coming into the market, purchasing land. There's also some POE activity on the property sectors on land purchases as well, which is also a good sign. The other thing that we also picked up is that aluminium production and steel production actually have to pick up a little bit as well in terms of single digit for as the year begins, which is also related to some of the construction materials. So I think overall, the kind of trajectory is more kind of moving up to a recovery, much more evident compared to a 1 quarter ago on property sector.
Your outlook then on credit spreads, baking that in, making the triple R cut in, are they trying to massage rates lower in China? Do we get lower rates too moving forward?
Yes, I think there's there's definitely potential for an LPR cut, and somewhere down the road, I think depends on how the economy recovery is. There could potentially be a little bit more flexibility when it comes to policy rate cuts as well, which means that we do think that at this juncture in time, China's CGBs could potentially look a lot more interesting compared to the last year as well, because last year we have the U.S. rate hike, we have a very strong U.S. dollars now coming into kind of towards the end of the rate hike cycle. China is more on the kind of supportive easing policy stance, and China government bonds or even China bonds still provide that diversification benefits, particularly on this kind of risk aware environment. Investors could potentially look for somewhere that they can hedge, and China CGB could potentially be looking interesting.